So, in our lecture on a very important area of the exam, and it's called consolidation or group accounting. Um, as you know, you've learned so many standards, and all those standards will come to play in the consolidation. However, there are additional standards that helps us to prepare consolidated financial statement or deal with the whole concept of consolidation. So we have IFRS 10, IFRS 3, IFRS 11, IFRS 12, IAS 27. We also have IAS 28. Actually, IFRS 5 too also plays a very important role here. So first of all, what we're going to look at is the introductory session of it. So I'm going to introduce it to you. So we first look at introduction to group accounting. And as part of my introduction to group accounting, the part that I'll be concentrating on will be IFRS 10 and IFRS 3. So we start with IFRS 10. IFRS 10. Now, the IFRS 10 introduces to us some terminologies that we may see in consolidation. IFRS 10 is about consolidated financial statement. All right. Now, what does IFRS 10 say? So IFRS 10 actually requires every parent entity to prepare consolidated financial statement. So it introduces to us the word parent. So as you see here, IFRS 10 says that an entity that is a parent, all right, a parent entity is required to prepare a consolidated financial statement. So that is the first thing we should get from the standard, that there is a requirement from IFRS 10. So we say IFRS 10 requires parent entity to prepare consolidated financial statement. So it's a requirement. Now, the question is that, what then is a parent? So if you are saying a parent entity should prepare a consolidated financial statement, what then is a parent entity? Now, a parent entity is an entity. So the parent entity is an entity that controls another entity. That controls another entity. So that is what a parent entity is about. So if there is an entity that controls another entity, then it means that that entity must prepare a financial statement. Now, another terminology you find in here is the entity that is being controlled. You see, the parent is controlling an entity. So that entity that is being controlled, which we say the another entity, is the entity that we call a subsidiary. A subsidiary. So a subsidiary is the entity that is what? Being controlled. So the entity being controlled is what we mean by a subsidiary. All right. So that is that. So in this introduction, you've understood that there is a parent entity and we know who a parent entity is. You've also understood that there is a subsidiary and we know who a subsidiary is. But when we say somebody controls someone, what does it mean? What, therefore, is this concept of control? What is control? Because we say that a parent that controls a subsidiary should prepare a consolidated financial statement. What then is a control? Well, a control is when you have power, all right? When you have power. So we say that when an investor has power over the investee, there is control. So if you have power over someone, then it means you can control the person. All right. Again, when that investor has the right to variable return. So if an investor has right to variable returns, from his investment in the investee, then it means that he has control. So what I would say is that let's relate it, let's make it practical. All right. So look at the concept of marriage. All right. So if and of course, those of us who are coming from a religious background of Christianity and Islamic religion, you do all know that when a man marries a woman, there is a level of control. Okay, so um, if your wife dresses some way, you can talk about it. Okay, I want you to dress this way. I want you to dress that way. So you are actually having a control. If you give birth to a child, you actually have a control over the child because you determine the school that he even goes. So that is that. That is the first point. You have power. All right. Now, again, you realize that at some point when an investor invests in a company and he has rights to variable returns from his investment in the company, then it means he also has control. He has right to variable return. And therefore, that means that he also exerts some kind of control because of the word, the right. All right. The right. Not only for you to be having the right to have the variable return from the investment that you put there, but also you have the ability to affect those returns because of your power. It's not just about the fact that you say they should pay dividend, but also by the fact that you can determine how much dividend. So that is kind of, if you go have a shareholders meeting and you are agreeing, then what you realize is that this person doesn't have only the power to say, okay, we are doing this, but also have the power to say how we are doing it. So that kind of power is there. So when an investor has the ability to affect, the returns, through its power over investee. So you can actually decide how it is going to be done. So by this, then we mean that somebody has a control. So you ask yourself, if we say a parent controls a subsidiary, ask yourself, does the parent have power? The investor is what we refer to as control. Does the parent has power over the investee? Do they have right to variable return? So so in short, mathematically, we need to explain this aspect well. Because you see, to be able to have the power, it must be expressed in the form of mathematics, because we know that every company is run by ownership in shares. We know that. We know that every company is run by ownership in shares. As a matter of fact, in our early education, we are told that a share is the unit of equity ownership, unit of equity ownership of a business. So it means that if you can own something which is control and have control, you need to have shares. That is one part of it. All right. So another part too can be in the form of a relationship. We talked about that. Even with the example I did with marriage, we talked about that. So these things that we've just spoken about in terms of trying to define control can be summarized. The summary of this all right. So in summary, what we are trying to say is that if you can have a power over somebody, then it means that you need to have what we call majority voting right. Majority voting right. And by this, to have majority in terms of 100%, it means you need to have 50 plus 1 upwards. All right. So 51 going. So that the remaining will be 49. So you will have power, because if every share is voting and 1 million people have the 49, if one person has the 51, he has 51 opportunities. So he will always override that. All right. But there is an important thing you need to also understand, especially from the fact that you have done IFRS 9. Now, somebody may not have the 51% at a time, but he can still have control. Question is how? So if somebody is holding what we call a potential voting right, holding a potential voting right, we need to be careful about those people, because we have learned what we call IFRS 9 convertibles. If you remember, convertibles. And when we did the convertibles, we realized that there is an equity component in the convertible. Okay. So if somebody has a potential voting right, example, the convertible, that are currently capable of being exercised, then you need to be careful of those people. All right. That are currently being capable or are currently capable of being exercised, then it means that person too can have control. Now, what do I mean by this? Okay, for example, let's say A is a person, all right, then A has 49% shares, and plus he also have, let's say, a 10% convertible loan. All right, let's say that 10% convertible loan is, let's say, 100,000. All right. We do know that the person can convert the loan into equity. And if he converts the loan into equity, his equity side, which is his share side, may increase, okay, to, let's say, 51%, just because he chose to convert it. Then it means that person too has control, because we say mathematically we are looking at what? 50 plus 1. All right, 50 plus 1. So if this person has 49, he kind of thinks it sounds okay that you can say he doesn't have control. But look at that same person. If he's having a potential voting right, which is in the form of a convertible, that when he converts his loan into equity, he can get to that 51% at any time, then it means that that person too has control. So be careful. Not all the time that somebody needs to have 51% exactly, but he may have a less than. However, if he stand the chance of converting his convertible debenture or whatever it is into equity to add up to what he already has, and that thing can move him to 51%, then it means the person too has control. All right. The last bit is that relationship can also exude control. Relationship can also exude control. It can also bring about control. All right. So that these are things you need to understand when we talk about the concept of what control. So it is, like I said, it is possible for somebody to have a less than 50%, but still have control. Why? Because that person has a convertible. All right. So that is that. Now let's look at this example. Let's look at this example. Look at this question. So we have Priscilla. Now, Priscilla has 40% in the ordinary shares of Owarewa. Now, another investor has 10% shareholdings in Owarewa, whilst the remaining voting rights are held by thousands of shareholders, none of whom individually holds more than 1% of the voting right. Priscilla also holds a debt instrument as at 30th April 2014. Are convertible into ordinary shares of Owarewa at a price of 4 shares. All right, 4 CD per share. Now, at 30th April, the shares of Owarewa is trading at, if the debt was converted into ordinary shares, Owarewa would hold what? 60% of the voting right. Priscilla will hold 60% of the voting right in Owarewa. Now, Priscilla and Owarewa undertake similar activities that will be they will benefit from what? Synergy. Now, the question is that, is there control in this area? As you see, the investor, we say somebody has control when the investor has power over the investee. We express that. Number two, when he is exposed or has right to variable return from his involvement in the investee. We've also mentioned that, as you can see here. All right. Then we also said that the person has the ability to also affect the amount of the returns. These are what IFRS 10 paragraph 7 tells us and uses to explain control. Now, it goes on to say that when you are assessing the control, an investor's potential voting right should be considered. Yes, potential voting rights are rights that you obtain in terms of you having a convertible instrument or options. So like you see, Owarewa has 40%, Priscilla has 40%, sorry. Then in Owarewa, then he has some debt instrument. And by converting the debt instrument, his ownership turns into 60. That tells you that Priscilla has control over Owarewa. So these are things that you need to factor in terms of whether there is control in an entity or not. So you see here, we say that Priscilla has a voting right that are currently exercisable. The word is currently exercisable. So that is it. And this is what we said here. A potential voting right that are what? Currently capable of being exercised. All right. So, and those should be factored into the assessment of whether somebody has what? Control. All right. The fact that the exercise price of the instrument, and you need to check that because a person will exercise. Listen carefully. A person will exercise a right when the exercise price is lower than the fair value or price of the market. Okay, so let me explain this thing to you so that you understand it carefully. Now, you work in a company. You are the CEO of the company, all right? Then bonus time has come. And instead of giving you money, they say that they are giving you options to exercise. So, option to exercise, to obtain a number of shares into the company, okay? To obtain shares so that even though you are the CEO, you also become a shareholder. So now that is it. And they are giving you, let's say, 10,000 shares at a future date. At a future date. So let's say the end of the year. At a future date, and the price, the exercise price, the price that you can buy those shares is 2 cedis. Now, the future date, let's say, is 31st December 2023. Now, when we got to 31st December, when we actually got to 30, so as at the time you are doing this, let's say it is August 2023. All right. By the time we actually get to 31st December 2023, the fair value, which is the share price in the market, of share prices in the market, is 5 cedis. But the company says that you can exercise it at 2 cedis. Now, my question to you is that, and if you want to answer this question, just kindly raise up your hand and let me know. Now, my question to you is that if the entity is offering something to you at 2 cedis, for which the thing actually in the market is 5 cedis, will you buy it? Will you exercise it? Yes. Who is answering me? Will you exercise it? In the market, it is 5 cedis. The entity is giving you an option to exercise it and buy it at 2 cedis. Will you exercise it? Yes, Augustine, will you exercise it? Hello, Augustine. Ima, will you exercise it?
Yes, I will exercise because I'll buy it at the 2 cedis and later I can even resell at the 5 market price and gain 3 cedis on it.
Exactly. So that is it. So if we bring it to the potential share analysis, then it means that this guy will exercise it and therefore his percentage will increase. Okay, let's turn the tables around. At this time round, it is 5 cedis here. And in the market, it is 2 cedis. Yes, what will you do? Will you exercise?
No, I will not.
Why?
Because if I exercise, it's like incurring a higher cost as against what exists in the market. Then in that case, probably I'll take the bonus and go and buy it in the markets and then at
Exactly.
a lesser.
That is the perfect answer. Please give me my bonus and let me go and buy it from the market. It's exactly like that. Now, so we are saying that in the consolidated financial statement, look at this analysis. Okay. So if we go back into our question, we do know that, yes, of course, they said if she exercises, you have 60% and all those things. But let's look at the exercise price and the market price that has been given to this person. Because that is the reason, a logical reason for the person to exercise or not to exercise. All right. So we are told that our trade its shares at 3.8, but the shares are convertible into ordinary shares at a price of 4. So if you are converting, you are doing 4, but in the market, it is traded at 8. The question is, will you exercise? So these are the questions you need to ask yourself. Of course, given this one, nobody will exercise when the thing is 3.8 and you are giving it to me at 4. So if he doesn't exercise, then it means she will still have the 40% and therefore will not have control. But assuming the tables are 10, then it means that she will definitely exercise and she will have control. So that is why we are saying that you need to look at the potential voting right. Is the shares capable of being exercised? If it is, then the person will have control. If it is not, the person will not have control. So in this particular example, because the share price kind of is lower and the price they are giving them is higher, they are giving Priscilla is higher, she will not exercise, and therefore there will be no control. So these are things you look out for, okay, in your exam. Just be careful, just analyze it well, and you will have it right. Okay, so that is that. That is that. Okay. So in terms of Owarewa getting, on the other hand, if she will exercise, if options are not, this is the opposite side of it. So if you turn it, then the person will exercise, then it means that she will have control, all right, and will therefore treat Owarewa as a subsidiary. All right, so that is that. That is that. All right. That is the bit that you need to understand from the IFRS 10 perspective of things. So that is the IFRS 10 perspective of things. Now, yes, IFRS 10 has said that we should consolidate when the parent has control. However, to every law, they say there is exceptions. So there are exceptions or cases where you don't actually consolidate the financial statement. And what are those cases? And that is what we are going to look at. Exceptions to IFRS 10, exceptions to consolidation. All right. Now, the first one is that when a parent of an entity is also a subsidiary of another entity, that parent is not required to prepare financial statement. So when a parent is also a subsidiary of another entity, consolidated financial statement is not required. What am I saying? So you have, let's say, company B, who is controlling company C. So he owns like 60%, which means there is control. He should be preparing consolidated financial statement. However, he will not when he himself, the B, is also controlled by A. So let's say A also holds 90% of B. So B therefore becomes what we call an intermediary parent. All right. So an intermediate parent who should not, or who is not required to prepare consolidated financial statement. So B cannot prepare consolidated financial statement. However, A can prepare consolidated financial statement. All right, so that is that. Now, these things happen, so we say that if the debt or the equity are not currently traded in the stock market, then it means that you are exempted from consolidated financial statement. Okay, so If you are not in the process of getting them traded, you are not required to prepare consolidated financial statement. Those companies that prepare consolidated financial statement are those companies who are trading their stocks, their equity, and their debt at the market. So it's either you are in the process of doing that or you are already there. If that is the case, then it means you should prepare. But if you are not having your debt, your equity traded on the market, if you are not in the process of getting them done, then it means that you are not allowed to prepare consolidated financial statements. All right, so please get to know that debt debt and equity traded on the stock exchange market, if you don't have such, you are not required. If you are not in the process of getting it done, you are also not required. All right. Another one is also the fact that if the company that you are investing in is an investment entity, so investment entities, don't forget, I talked about status here. I talked about status. Is it public or you are getting public? If not, please, you are not allowed. All right. You are not allowed. Now, so investment entities. Now, when we talk about investment entities, these people, they obtain funds. They get your money. Then they do investment with your money. They invest your money. Then you earn returns. These are purely investment entities, not trading entities, investment entities. So it's either you get returns or capital appreciation. Remember IAS 40. All right. Now, if you have an investment like that, if you have an entity like that, which you invest your money in, please, you are not required to prepare consolidated financial statement, all because it's an investment entity. All right. Now, what you do is that these investment entities, you have to measure your investment at fair value at each reporting date. Okay. At each reporting date to determine what gain or loss. Okay. So you do fair value at each reporting date, but you don't consolidate. All right. To determine change in fair value. And that one, change in fair value will go to your P&L. All right. Another set of entities that you don't also consolidate is like an associate. You don't consolidate an associate. Why? Because you don't have that one, even though you have the investment in there, we all know that what you have is what we call significant influence. That one, you don't have control. All right, you don't have control. Joint venture is another type. Joint venture. That one too. So this one is covered under IAS 28, and this one is covered under IFRS 11. Those ones, you don't consolidate. All right. So please take note of all these things. These are exceptions to the consolidation issue. All right. Any question at this point on IFRS 10? So IFRS 10 just introduced to us that we should consolidate whenever a parent has control. All right. And what do we mean by parent? A parent is the one that controls another entity. And that another entity is what we call a subsidiary, i.e. the one that is being controlled. And what is control? Control is when you have power over the investee. You have power, you have right to variable returns. And also you have the ability to affect those returns, given your power. Mathematically, we say the power is having 51% or 50 plus 1, but not 50 plus 1%. All right. And we also talked about the issue of having a convertible and the potential of you converting it into getting more than 50%. We also talked about relationship, all right, that exude control. So we did some examples around all these things. Then we have spoken about the exceptions to the IFRS 10. Entities that are not public it's not compulsory for them to prepare a financial statement. If they are also not in the process of getting public, they are not. When a parent is also a subsidiary of another entity, no. If it is an investment entity, that one to know. Of course, associate and joint venture, we don't consolidate. So that is the first bit of our introduction to consolidation, and you need to get that thing in mind. We now come to the timing of consolidation. Timing of consolidation. When do we consolidate? When? Timing of consolidation. So let's look at timing in consolidation. When do we consolidate? When do we consolidate? Now, I'm going to give you a 3-piece timing in consolidation. Here we have the acquisition date. Acquisition date. It's very, very important you understand these things. These are the fundamentals to it. Then at the tail end, we have the reporting date, the date you actually prepare the consolidated financial statement. We call it the reporting date. All right. Then in between is what I call the interim. The interim. All right. Now, so in your exams, you see that there has to be a date somebody purchased someone. There always have to be a date. Now, what do you do? At that date, when someone has purchased someone, what you need to bring in is the concept of IFRS 3. So this is where we talk about IFRS 3, business combination. Business combination. So if the person acquires, and this is what we are looking at, is when somebody has acquired an entity. So let's say A acquired B. All right. So that is what we are talking about. Now, we need to find out if we have to prepare a consolidated financial statement, because we said that the only time someone is required to prepare consolidated financial statement is when? Yes, who can tell me, when do we prepare consolidated financial statement? When? When do we prepare consolidated financial statement? Per the IFRS 10 that we just did, when are we supposed to prepare consolidated financial statement? Yes. Yes, Emmanuel. When are we supposed to prepare consolidated financial statement?
Okay, so when the entity, I mean, it's not also controlled, or it's not a subsidiary to another entity.
You don't go to the exceptions.
Oh, okay.
I mean,
Then
from the
when
beginning,
the
we
person has a
understand
good
the exceptions. Please come again.
control, I say
When you
I
have
mean the
control.
entity control, yeah, when you have control, or unless you have
Exactly.
voting rights about 50%, that's 50 plus 1.
Good. So that is what you have. Now, so in your exams, there should be nowhere a person doesn't have above 50, you should consolidate. It's as simple as that. The standard says you can only consolidate when the person has control, which means that 50 plus 1 or 51 above. So it will be a rebellion for you to consolidate when the person doesn't have that. So these are things you do in the exams. I mean, these are how we separate those who have learned from those who have not learned. So even in the advanced level, where there is something called step acquisition, you see that the company has bought 10%. Then that company goes in there and buy another 30%, making 40. Since they still don't have control, you cannot consolidate. You cannot do consolidation. All right. So we consolidate when you have control. Now, immediately you have control and you are thinking about consolidation, we use IFRS 3 business combination. IFRS 3 business combination says we should apply what we call acquisition method of accounting. You apply the acquisition method of accounting. Later in IAS 28, you realize that for associate and joint arrangements, those side IFRS 10, you apply what we call equity method. Here we use acquisition method. Now, what does the acquisition method say? Acquisition method says that immediately somebody has control, number one, identify the acquirer. Immediately, please, we are going to practice this in solving consolidation questions. So I want you to get the fundamentals right. So immediately, you identify the acquirer. That's the first thing you need to do, identify the acquirer. The acquirer. Now, what do we mean by identifying the acquirer? We are talking about looking out for the parent, okay? The parent entity, all right? Then if you get the parent entity, how many shares, all right? Look at how did he become the parent? Is it by dominating management? Is it by shares, which is voting rights we've talked about? All right. Is it by size of relationship? So identify the acquirer. Identify the acquirer. Now, once you identify the acquirer, the second thing you need to do is to look out for the acquisition date. That's the next thing, the acquisition date. So if you don't show all these things in your consolidation process, you are not obeying the rules of engagement, which is the standard. So find out the acquisition date, all right? Find out the acquisition date. Now, so acquisition date is the date of control, the date the person obtains control. And we've already defined that control is mathematically 51% and above, or 50 plus 1. So now let me ask you a simple question. This guy, entity A, buys 40%, all right, in another entity on 01/01/2023. Then he buys additional 10%, or let me say additional 12%, okay, on 31st December 2023. My question to you is that when do we consolidate? Which of these two dates are we supposed to consolidate? Yes, which of these two dates are we supposed to do consolidation? This time around, I want a different person, Nibata or Rampa. Yes, which of these two dates are we supposed to consolidate?
That is the 21st.
Which one? The 31st?
No, the 21st. At
I don't
40,
have 21st, so it's either 1st or 31st. So which of the dates?
For the consolidation, 50 plus 1.
So which date? My question to you is which date?
21st December. 31st December.
All right. So if I ask you why 31st December, what will you say?
Yeah, I will say that it's a fair because at that point he has control by the.
All right.
Uh,
So he has control by virtue of 51 votes. All right. So these are what you need to know. And see, if you get these fundamentals right, there's nothing like console is difficult, sincerely speaking. If you get the fundamentals right, you can do complex, you can do whatever, you understand what you are doing. All right. Then the standard says that from acquisition accounting, the next thing, the step 3 we need to do. So you realize that these two processes that we have established here will be what later I will show you as your workings 1 in your process of doing your consolidated financial statement. Now, the next step is you have to do the identifiable assets and liabilities of the subsidiary. Identifiable assets and the liabilities. Now, let me ask you a question. Which standard did we do that you met this word, identifiable? Do you remember any standard we did that brought out this word identifiable? Do you remember? Yes.
Yeah.
Which standard is that? Which standard is that?
I stated.
IS 38. That's correct. But do you remember what we said about it? IS 38. So the recognition criteria of intangible asset was that it has to be identifiable. If it is not identifiable, we don't recognize it. So when I say we are going to find out the identifiable assets and liabilities of the entity, it means that if you have any inherent intangible, or let's say inherent goodwill, that one cannot be recognized. So you have to fix that one out. It cannot be recognized. All right. So these are things we build on. Now, so we say identifiable, and per IFRS, IAS 8, we've learned a lot under that. So if you want to actually recognize your inherent intangible, then it must pass the development test of pirate. Remember that. Okay, so that is that. That is that. Identifiable. Remember, we say something is identifiable when it is what? Separable. I'm sure you remember all those things. And the person has a legal or contractual right to that. So what do we do here? So here what we are doing is that we identify the fair value of net assets. Fair value of the net assets of the subsidiary at acquisition. So that is what we do. Remember, we are still doing acquisition accounting. So these are things we do on the acquisition date. These are things we do on the acquisition date. Now, so that is that. You have to also remind yourself that when you are doing these things, there are other standards that you have done that you need to watch out for. So watch out for what we did, contingent liabilities, because we are talking about liabilities too here. Watch out for contingent liabilities. What standard did we talk about contingent liability, and what did we say about contingent liability? Yes. Who can tell me? Then also watch out for provisions. Provisions. Watch out for intangibles and goodwill, internally generated goodwill. All right. Yes. What did we say about contingent liability? IAS 37, what did we say? Don't tell me you don't remember. What did we say about contingent liability? Yes.
The liability is dependent on events occurring. So if that's why it's contingent, is based on something happening. Before we then recognize.
Yeah. So what do we do with it? What did we say you do?
So we will disclose. We will disclose.
All right, we will disclose it. However, okay. However, here in acquisition accounting and in business combination, it's not about disclosure, okay? It is about measuring it at fair value at acquisition. Fair value at acquisition. So here, we don't disclose contingent liabilities. We measure them at fair value at the date of acquisition. You see, this is the difference between somebody who joins consolidation class and somebody who did not. Because for the person who really don't understand how acquisition accounting is, or the acquisition method of accounting is, all that the person knows is that contingent liability is what? Disclosed. But when it comes to business combination, IFRS 3, contingent liabilities are recognized at what? Fair value at the acquisition date. So that is a key note you need to take into consideration. When it comes to provisions, all right, provisions are only recognized if and only if they existed at the acquisition date. All right, recognize if and only if they existed at acquisition date. All right, so that is that. As for the intangibles, we've already said that if it is internally generated, clear it off. All right, so that is that. So later on, you realize that this aspect of what we've learned will form our workings too. All right, you learn that. Okay, then we come to our step 4. Step 4 is about we determining our goodwill. So determination of goodwill. These are what IFRS 3 business combination tells us. Determination of goodwill. So we will determine the goodwill, and I will show you how you determine goodwill. So you realize that in goodwill, there are 2 methods we use to derive goodwill. We have fair value method. We will discuss that. The fair value method, which of course some call the full goodwill method. The full goodwill method. And we also have what we call the proportionate method. Proportionate method. And for which that one too you might have heard called partial goodwill method. Partial goodwill method. So we will learn all these methodologies. Partial goodwill method. So this is what we do. And later on in the course, you realize that this aspect will form our workings 3. Our workings 3. Now, the last thing acquisition accounting tells us to do is for us to determine our NCI. Determination of NCI. Because what is NCI? NCI means non-controlling interest. Non-controlling interest. Okay, that is what we call it. So we call it NCI. Now, in the old books, you will see majority interest and minority interest in the old books. But as the standard evolves, we call them the non-controlling interest. All right. Now, if somebody bought, let's say, 60% to get control, then the NCI, which is the part that they don't control, will be what? 40%. All right. So you determine that at the acquisition date. All right. And you even realize that the determination of the NCI will also have a bearing. You have to take it from how you developed your goodwill. All right, so these are the things we do in the acquisition accounting. Of course, there is a workings. This one will later on you understand that this is our workings 4. Now, there is workings 5, which we call group retained earnings, but that one is not an acquisition accounting. We just add it just because we want to prepare our balance sheet. So you will add it. Later on, we will add a workings 5, but that one doesn't stem from acquisition accounting. All right. So that is that. Now, so that is the first side of the timing. Now, on the last date of acquisition, what we do, which is, on the reporting date, what you do is that is the date you will prepare your consolidated financial statement, i.e., we are talking about consolidated SOFP. You prepare consolidated P&L and OCI. You may even be asked to prepare consolidated cash flow, but at this level, we don't burden you at that. At the corporate reporting level, you will be asked to prepare, you can be asked to prepare consolidated financials, consolidated cash flow. All right. Even some of your subsidiaries can be a foreign subsidiary where you need to bring in IAS 21. Now, in the interim, in between the reporting date and the acquisition date, things happen. And those are what forms your adjustment. So you do some adjustment, things happen. So you do some adjustment. Some of the key adjustments are that you do fair value adjustment. Fair value adjustment. And to every fair value adjustment that you do, you have to be doing fair value adjustment, depreciation, or amortization. So the fair value adjustment, depreciation, or amortization, depending on what the fair value adjustment affects. All right. We will also be dealing with something we call PAPs, provision for unrealized profits, because they may be trading among themselves and they'll be getting some profit, and we need to erase that because you can't sell to yourself and make profit. And the PAPs, there are 2 aspects of it. We have the inventory PAP when they sell inventory, and we have when they transfer PPE. So the PAPs, PPE PAPs. All right, we will learn these things. Okay. Then also when they have intra-group tradings. So intra-group tradings, they trade among themselves, the intra-group tradings, which will give rise to something we call in-transit items. In-transit items. So there can be cash in transit. So it can be cash in transit. All right. Or inventory in transit. Okay, so we will deal with the in-transit items. Sometimes too, there is intra-group receivables. The trading will end up bringing up some intra-group receivables, intra-group balances, receivables and payable balances. All right. So we will look at all these things. We will look at all these things. We have what we call uniform accounting policy. Now, imagine you are buying a company for which the accounting policy is different from you, the parent, and now you need to impose the parents' accounting policies on them so that they can be at par for you to consolidate. These are all things that we will look at. All right. So this is the introduction to consolidation. Now, any question at this point? Because from here, we are now stemming to do how to prepare a consolidated financial statement, how we actually prepare the balance sheet, consolidated balance sheet, how we prepare consolidated P&L. And from here, we will start looking at the figures. So any question at this point? Any question at this point? Yes, any question at all. If you didn't understand anything about the introduction, then you can ask a question now.
Okay. So
Yes.
the PAPS, you said the PAPS is what does it stand for?
It's provision for unrealized profit. We will expound on it. Everything that you see here, we are going to expound on it. All right. So it's called provision for unrealized profit. It's like selling to yourself. You see, when you acquire a business, the business become you. That's why you are able to even consolidate. So how can you sell to yourself and make a profit? Yeah. So we will be looking at that.
Okay.
All right.
Okay.
So now, this is your machine gun for consolidation. If you understood everything here, the rest is just about the figures. All right. Okay.